such a great pleasure to have with us the one and only Mohnish Pabrai, who truly needs no introduction to the MOI global community. Very excited, Mohnish, that you are joining us after, I believe, 2 years. We do this on a 2-year cycle. There's a lot to discuss. We got a ton of questions in from both MOI members as well as the broader investment community via X. And so why don't we jump right in? I think the most questions were actually around the coal industry, believe it or not. So to the extent that you're willing to discuss, would love to hear your thesis, and feel free to go as far back as you like to sort of lay the foundation for how you became interested.
I mean, we are still buyers in the space, so we don't need more competition in terms of, more people coattailing, etc. But I can make some general comments from a mental model and education perspective. And I think maybe your listeners may find this useful. So just taking a step back, a long time ago, I think this must be close to 25 years ago, maybe 24, 25 years ago, Warren Buffett had auctioned off his wallet, and he had done it for charity. I think it was at Boys Town or something in Omaha. And he had put a stock tip in the wallet. And, that went for quite a bit of money. I don't remember how much. But it turned out the stock tip was a company called First Industrial, which used to be a REIT, an industrial REIT in Chicago. And I was friends with the CEO of First Industrial. We were both in Chicago, so we knew each other. And I told him that, hey, by the way, do you know that apparently Warren must be a shareholder because he recommended your stock? And one of the things about REITs in general is that Berkshire Hathaway doesn't buy them because the tax treatment is not friendly for corporations to own REITs. So this was a case where he was probably buying it personally, and there was no conflict with Berkshire because Berkshire couldn't buy it even if it wanted to, because it just doesn't work very well. So I told him it's probably likely that Warren personally owns his shares. So he was intrigued by that, and he reached out to Warren and just said, how humbled and grateful he was that Warren would even have spent any time looking at his small business. And Warren responded to him saying that if you're ever in Omaha and don't call me, I will be quite upset. So then my friend basically told him, what a coincidence. I'm going to be in Omaha day after tomorrow. So he went to Omaha. He and Warren had lunch, etc. But one of the things that John had told me at around that time, I used to own First Industrial stock as well, is that he had mentioned that they mostly invested in industrial real estate, kind of warehouses and factories and that type of stuff. And he said that the gestation period to build a warehouse usually is less than a year. And he said the gestation period to build an office tower is maybe 3 to 5 years, more like closer to 5 years with all the permissions and all of that. He said that in industrial real estate, we don't get big cycles of booms and busts because if there is tightness in the market and a lot of people go out and build a bunch of warehouses, that space is going to hit the market in 12 months or 18 months. And there may be, some temporary weakness, but basically it would immediately, if there was overbuilding, it would reduce the propensity to build more warehouses. And as the economy grew, that excess capacity would kind of get absorbed, and things would get to kind of baseline. And again, when things got tight, people would build again. But he said that in office towers, because of the kind of 5-year period, when office vacancies become very tight and rents go quite high, everyone and their brother starts building towers at the same time. And because of the 3 to 5 year gestation period, all these towers hit the market at around the same time. And the boom and bust cycles are much more pronounced because of this lengthened period. Because basically, for example, if in 2020 we have a tightness in office towers, the first ones are going to get delivered in 2025. So people will still be starting new office tower constructions in 21, 22, 23, and even 24, because they haven't seen the impact of all the inventory that's about to hit. And, real estate guys are eternally optimistic till they get eternally pessimistic. And of course, once that inventory hits, you've got more inventory coming for another 4 or 5 years because of all the stuff that started. So basically, you would have a 5 year boom followed by a 5 to 10 year bust, and then the cycle would repeat. So he says that the boom and bust cycles get kind of aggravated in the case of office towers. And in fact, in Austin, where I live right now, we are seeing that play out right now with tall residential towers, kind of luxury residential towers. I mean, Austin was going through so much growth, 3, 4 years ago, that real estate was very tight and difficult to get a space and all that. And pretty much everyone started building. And now these big towers are being completed. Some of them are going to be completed in the next 1 or 2 years. And there's a huge glut and such. So it's not just office towers. We see that even in residential towers because of the same kind of phenomena. But this particular notion of the gestation period and boom and bust, how pronounced it is, what I found since that time when I spoke to John about this is that it comes up in many other sectors. And I noticed the same thing around, I would say like 22 years ago in the oil shipping business, the very large crude carriers. And again, this was a situation, I think, in maybe 2001 or so, when there are about these 400 of these VLCCs, very large crude carriers, that are used to carry large amounts of crude around the world. And there was a big glut. I mean, basically, oil demand went down and there were too many tankers. And because there were too many tankers, rental rates collapsed. And these tankers were being rented out below, they were rented at a loss, basically, because it was better than making zero. If your cost was $15,000 or $20,000 a day, on one of these VLCCs, the rates went down as low as 7 or 8,000. And what happened at that time was that there was a lot of scrapping because, these owners were so distressed. The global fleet went from like 400 to 360 or 350 with a lot of scrapping because these owners wanted to get some cash. And then the market tightened, oil demand came back, but the tankers have the exact same situation as the office towers. They take again 3, 4 years to get delivered after you place an order with the Korean shipyards. And also the second thing that happens is that when there's a boom, so what happened is these oil tanker rates went to like 7,000 a day. They went all the way to $250,000 a day. I mean, they went to the other extreme. It was just extreme, obscene profitability for these tanker companies. And everyone and their brother at that time went to the Korean shipyards and placed orders. And of course, the Koreans are not stupid. They know that they are the toll bridge that everyone has to pass through to get their tankers. So prices for new build tankers went through the roof. Like what used to be a $70 million ship might be quoted at 120 million, 130 million, 150 million, because what are you going to do? You want a ship, you pay what the guy wants to charge you. And of course, the problem is that when those ships got delivered, again, they all hit at the same time and then, the same cycle. So what I've noticed in the last 2.5 decades is this mental model, which applies to office towers, as actually applies to many different classes of investments, and actually understanding that mental model can give you a big edge. And one of the things in the coal space, especially the metallurgical coal space, which is coal that's used to make iron and steel, is that coal is now a four-lettered word. So I remember I was talking to one of the coal CEOs in the Appalachians, and this is not a met coal company, this is a thermal coal company, I think CONSOL Energy, which now just merged with Arch and it's become Core Natural Resources. And CONSOL is a 150-year-old thermal coal company, very, very high quality thermal coal, extremely low cost operation. In 150 years of operating, because of their strong product quality and low prices, they've never had financial distress. They've never gone bankrupt, which is almost an anomaly in mining. In 150 years, CONSOL never had to restructure, never went bankrupt, nothing, because they were always at the bottom of the end of the cost curve and they always had the highest quality coal. And so they always made money. Literally, they would be the last mines to shut down. And the CONSOL senior management was telling me that they've had banking relationship with JP Morgan Chase for maybe several decades might be 50, 60, 70 years. And JP Morgan told them that they can no longer have them as a client. Now, CONSOL is not borrowing any money. They have 2 or 3 billion in revenue. And so if you're a commercial banker of someone like CONSOL with all their letters of credit and all the, cash flowing through the account, it's a highly, highly profitable account. For a JP Morgan to come and tell them that they couldn't have them as a client because they were pretty much a ideal client was just because of ESG pressures. And these ESG pressures have gotten very irrational. So CONSOL, for example, has difficulty getting workers' comp insurance. Now the company is very willing and does self-insure for millions of dollars per incident or per worker. So they actually don't need the insurance. They're effectively self-insured. They just need insurance to satisfy the statutory requirement that they have workers' comp insurance. And so the insurance company is never going to see a claim. But again, the same thing, because of ESG pressures, they have a lot of difficulty getting quotes. They have a lot of difficulty getting surety companies to give them quotes. So literally all the kind of factors of production that they need to run their business treat them like a pariah. And especially historically, mining companies, they needed to raise debt in addition to equity whenever they were going to have some kind of capex or growth or whatever. If a JP Morgan is not interested in having you as a banking client who's never borrowing money, they're definitely not going to have you as a client that they're going to lend money to. And so these coal companies basically had two things happen to them, which were very unusual for the mining business. The first is because of the Ukraine war and the supernormal pricing for coal in 2022, all of them were debt free. They paid off every last bit of debt, which was never the case. Coal companies, mining companies always had debt. And that's what would usually get them into trouble, is because prices would go down, there'd be a down cycle, they couldn't service the debt, they would go bankrupt, and then the cycle would repeat and so on. But we had this situation starting in 22 and 23, where a lot of the coal businesses were net cash, which had never been net cash. And not only were they net cash, the second issue is the same boom and bust mental model applies here as well. So let's say, for example, there's a downturn in the metallurgical coal market where prices are too low. Everyone's losing money or barely making money. Well, what would happen is that the high cost mines eventually would shut down because they would try to run them for some time even at a loss because they'd be hoping for a turn. But at some point, if this persisted long enough, they would shut down. And in fact, we currently have weak pricing for metallurgical coal, and a number of Appalachian mines and mines around the world have shut down. And now when these mines shut down, restart is very complicated. So let's say, for example, metallurgical coal prices right now, PLV, the Australian index, let's say it's 190 or 200 per ton currently, which is quite low. And a lot of producers would have difficulty making ends meet at that price. Let's say, for example, the price went to 300, 250 or 300. Well, that would make it very profitable for a lot of mines, including the mines that have recently shut down. But if those same companies or individuals tried to restart those mines, they would face a lot of difficulty. So typically when you shut down a coal mine, what happens is that you lay off all the miners and you sell off all the equipment. You pull all the equipment out and you sell it off, because what are you going to do with it? I mean, you want to raise as much money as you can and salvage whatever you can. So the equipment is gone, the workers are gone, and sometimes the mining permit is gone because you got to keep paying royalties and different taxes, etc. So the permits may be gone as well. Now, when you want to do a restart, the first issue you're going to face is there's no financing available. So any restarts would need to be kind of all equity restarts, which is unusual in mining. Even if you could arrange the money on a pure equity basis, the difficulty with raising money on a pure equity basis to start a mine where coal prices are high is there's no assurance of what the coal price is going to be 6 months, 1 year, 2 years, or 3 years from now. So what type of risk capital would be willing to come in, equity or debt, when the future is unknown? The $300 price might last for 3 weeks or 3 years. We don't know. And so first is the financing debt or equity would be problematic. If that hurdle were crossed, when the index prices go high, there are no miners available. And it takes years and years and years to build those skills. So it's not like you can go place an ad and hire miners. So when you've gotten rid of your miners and they've gone, taken other jobs or gone to other industries or whatever else, trying to get miners back or hire miners in a $300 per ton environment would be very challenging. So that'd be the second barrier to entry. The third barrier to entry would be that when you try to procure the equipment, just like the Korean shipyards, the equipment is going to be 2 to 4 year backlogs, 2, 3, 4 year backlogs. And just like the Korean shipyards, you would be paying very high prices for the equipment because the equipment manufacturers are in the driver's seat. So you would face a multi-year period to get the equipment, a lot of challenges to get the labor, a lot of challenges to get the capital. And then even the permits may become difficult depending on the geographies and such, because coal is a four-lettered word. So unlike office towers, where there's some predictability and such that, your main kind of gating factor would be, is someone willing to lend to you? And if rents are high, there may be banks willing to do that. There may even be people willing to sign leases with you in the future, etc. So coal has this situation, I think, with the boom and bust that is, I think, more intense now than with a lot of the other situations. We see this boom and bust situation not just in office towers or residential towers or coal. We see it in many, many places. So, for example, if we were to look today at offshore oil drilling rigs, which went through a period of severe distress a few years ago, and again, they have the same situation, 3 to 4 for 4 years to build a rig. And these rigs cost $1 billion, $1.5 billion. And again, currently there is an oversupply. So no one's going to build a rig when there's an oversupply. But, when it gets tight, again, you've got a 3, 4, 5 year period. I think from education perspective for the MOI global community and your listeners at large, I think that I have found in my investing career a focus on this mental model to be very lucrative. And once you understand this mental model and you're able to go long in one of these areas at the right time in the cycle, what can happen on the other end can challenge your wildest imagination. So the booms can be very spectacular. So what I find with some of our coal bets is they have no debt. They've got a very good position on the cost curve. And, we kind of break even or maybe lose a little bit of money at the low end, but when we've got supernormal profits coming at the other end. So that's a good equation from my perspective.
Well, thank you so much, Mohnish. That really is very educational and can be applied, as you say, to many different industries at different points in time. It sounds like capital cycle theory on steroids right now for coal and maybe for offshore drillers as well. Or some even say, if you take copper miners, it takes like a decade or something like that to bring a new copper mine online. And in something like copper, you have the long-term tailwind also of greater electricity and so forth. Maybe wondering, if that's the thesis, why not also expose yourself to a few other industries that have that same thesis as kind of a risk management tool?
I'm always open. I like that model, but I think that it's not enough to just understand that a particular industry has the booms and busts. You also have to have some other ingredients in place, the right management team, the right capital structure, typically you would be coming into these industries at times when things may not be, I mean, they will not be at a boom. They may not be at the absolute bottom, but they may be somewhere between the bottom and the boom. And so you typically would be entering at a time of murkiness. And so being able to, for the entity to have the resilience to live to see the boom and fully capitalize on it will vary from business to business. So one would need to evaluate that. But yeah, absolutely, it applies in many different contexts.
And so it sounds like that is another kind of pattern, or where pattern recognition comes in, comes with experience. Also, as you said, with the tankers, I remember probably a couple decades ago or more when you invested in those when they were trading for less than scrap. So how do you kind of take that and also the other side, which is investing in great businesses for the long term? I know you do both. How do you trade one off versus the other?
The tanker bet was quite profitable, but it was extremely painful. And I just want to explain that a little bit before I answer the rest of your question. Basically, I had done at that time only first order thinking. I had not done second order thinking with the tanker. So it was very clear to me when I made the investment in Frontline tankers, the VLCCs, that all their debt was non-recourse. The debt was at the individual tanker level. And the parent had almost no debt. And there was a ready market for these tankers to be traded. There's a market for them to be scrapped, etc. And when you looked at the market cap and the debt, and you looked at just kind of liquidation value of the portfolio, there was no way you could lose money. I mean, the market cap was so much below liquidation value. And so I didn't even pay a lot of attention to the upside. I just knew that from a downside perspective, it was very protected. And it was a relatively easy, 50, 70, 80% return in maybe not that much time. And in fact, I think in less than a year, maybe even less than 6 months, we had like a 70, 80% return. And I sold our position and I patted myself on the back saying, well done, Monish, and then completely missed what happened after that. So I think if I had held on to Frontline for the next few years, because, things went to stable, the rental rates went to 20, 25,000 a day, which means they were profitable. The stock moved up. And then it went all the way to $250,000, $300,000 a day. And at that point, I mean, it's ungodly cash flows coming into that business because their entire fleet was on the spot market. And what I did not appreciate then is John Fredrickson, who was the chairman and CEO, was a gifted capital allocator. I mean, just an incredible operator. And so it would have been, I think, when I calculated in about 4 or 5 years, a 70 bagger investment for us. Instead, it wasn't even a double. And that was terrible. And so it got seared into me that, and so one of the things to understand is these things don't go into nice buckets where you can say that Google is a great business and the oil tankers are just a special situation. That's not quite true exactly. I mean, I think that oil tanker business was one could have just done some second order thinking and understood that there were some possibilities, some non-zero possibilities, that there were some spectacular result possibilities if one just hung on for a little bit. So I think in investing, flexibility is important. I think I always like to say that Warren Buffett has a kind of a Swiss Army knife in his pocket when he goes about doing his investments. And for example, when Berkshire made their investment in the Japanese trading companies, I mean, they borrowed almost the entire amount. This is a company that is drowning in cash, 100 billion plus in cash. And he still borrows the amount for the entire investment in yen because mathematically it was the right thing to do. I mean, it was just a infinite return on equity that he got on that investment is truly spectacular. So I think in investing, obviously, the best place to be is the great businesses that are bought at great prices that are going to execute well for a very long time. And you're going to end up with, 10, 20, 30, 50, 100 times your money in some 10, 20 years or whatever. So that's ideal. But some of these other things that are, which might be categorized as special situations can also be, the lines are blurred. It's not very clear red line or black line that one's on one side and one's on the other. So flexibility is important and being open is important.
And I believe that was a little bit also the thesis with Micron when you first came across it, because that industry had been basically a bad commoditized industry for a long time, and you saw that that was changing. So would you say that was also a little bit along those lines?
Yeah, I mean, Micron was an oligopoly, the three players. The barriers to entry are extremely high. I mean, it's almost impossible for any, even if you gave somebody $100 billion to enter the memory business. I think it's, in fact, I think the CFO, I think the one-time CFO of Micron had told me once that there is so much black magic involved in the production of memory chips that he said that if one of their fabs burnt down and they've got all the patents and they've got everything, they aren't sure that they can get a replacement fab up and running, even though theoretically they know how to make memory, because there is so much kind of black magic type stuff in the production of memory, the yields and all that. So it's a very difficult business. And yeah, so yeah, if you've got three players and they're rational actors and they're likely to be rational actors, then that will likely work out well. And I think our Micron bet worked okay. I mean, in the sense that I think what happened is I think we had a double in a few years, but then other stuff showed up on the radar that looked just far more interesting. And so I made the switch and moved on. But yeah, Micron, especially now when we see everything that's happening with AI and all that, I mean, the memory guys are a good place to be.
And another another example, I believe a couple of years ago, you looked at Meta and said that it was an easy double, which it has been even more than that. And there's a compounder that got really cheap. So, given how many great ideas you find, how do you think about portfolio concentration and how many ideas to own at any given time? Because it seems like some of these ideas could be owned in parallel instead of focusing on one or the other.
Yeah, I think Meta was a good case. It looked cheap. It's a good business. A number of the businesses inside Meta are products that we all use on a daily basis. So a lot of people would have competence and understanding of what Meta's business is. I actually never invested in Meta, even though I saw that. And probably one of my flaws and mental blocks is I have difficulty with the mega caps. Just kind of the law of large numbers is something's really big. Well, how much more bigger can it get? Like, I mean, if you make an investment in NVIDIA or Microsoft or Apple, multi-trillion dollar market caps, where is it 10 or 20 years from now? And someone like me would be skeptical, and sometimes I'd be wrong about that. So for whatever reason at that time I didn't go for Meta because of this concern, and probably because there were other names on the radar that looked interesting. I don't know whether they performed as well or not, but that's just the way it rolls. What I try to do in portfolios typically is a 10 by 10, where if I'm making a bet, I make it 10% of the portfolio. Now, what ends up happening is that if you get a very big winner in one of those bets, then the portfolio will start to get skewed. And I see different degrees of skewing in some of the different portfolios I run. So, for example, we have an offshore fund and an offshore hedge fund, and it has 400 odd million in assets, and that fund alone owns 20% of a business that we found extremely cheap in Turkey, real estate investment trust, Reysas. So, I mean, I think when I first visited Reysas in 2019 and the first time I ever heard of them, the market cap was $16 million. And now it's over $1 billion in the last 5.5 years or so. And I think Reysas is north of 60% of that offshore fund. And by the time we are getting to our fourth position in that fund, it's 100%. So that fund only has, like, I think 5 stocks in it. And because what happened over the years is that we kept the ideas that we had the greatest conviction on. And whenever there were redemptions or things going on, the lowest conviction ideas were the ones that were candidates to be sold. And that's a normal situation that should be happening in portfolios. But I warned my investors that we are not cutting position size for the sake of diversification. They should cut exposure to the fund if it's a large portion of their net worth, etc. And some of my investors did that, which is great. And so basically, I just told them that we are going to run this fund concentrated because that, on a risk reward basis, seems to be the best way to go about it. So a 10 stock portfolio in that particular case is now a 5 stock portfolio with very extreme concentration. The other funds are not so concentrated, but they also, by the time you get to the fourth position or something, a fourth or fifth position, you might be at 90% of assets. And again, I think that's a natural outcome when some winners get going, and we take it from there.
And Mohnish, how do you think about which countries are investable or uninvestable at any given time? For example, there's a lot of cheap equities in Hong Kong and China at the moment. Do you have a view that it's simply there's a downside scenario where that's a zero due to geopolitics?
No, I think that would generally be a mistake. If investors take a kind of a wide paintbrush and do that with different countries, I think they'd be missing a lot of opportunities. So the thing is, a devil in this business is in the details. When we invested in Turkey in 2018 onwards, then and even now, the currency has been a basket case. Inflation has been extremely high. Now they've got a very good central banker and he's taken some great steps. And I think inflation is coming down quite aggressively, which is great. But our focus was on businesses that were immune to these issues and where these issues were irrelevant, but where investors with kind of the broad brushstrokes were just exiting. So yeah, I think in general, if you look at places which have historically had macro issues and have had a mass exodus of investors, like let's say, for example, places like Argentina or Brazil. Argentina is going through a big change right now. There aren't very many listed companies, unfortunately, in Argentina. Brazil is a little bit more interesting from that perspective because there are more listed companies there. So I would say, like Charlie used to say, you go fishing where the fish are. These areas where there is obvious distress and obvious exits taking place, the focus has to be on the highest quality businesses in those places with the highest quality management teams, where the macro situation that is causing the distress is irrelevant to those businesses. Like, for example, in Turkey, if you were to invest there's a listed company that is got the exclusive right to franchise Berg in Turkey, for example. They've just been growing like crazy last several years and doing very well. And so that business is going to transcend a lot of the kind of macro noise. And that's what we did in Turkey. We looked at businesses where the currency was not relevant and the inflation was not relevant.
Mohnish, how would you say your investment process has changed or evolved since you started investing about 3 decades ago?
Well, the big change that takes place for all investors is we keep learning more things. And our understandings and different mental models get more resilient and get stronger. Like, for example, the boom and bust mental model, which I encountered maybe 20 plus years ago, but it took this period of time to really appreciate kind of all the nuances associated with that. And so, yeah, we get expertise in different industries over time that we didn't have. We get expertise in different ways of looking at things, maybe different geographies and cultures. And so all of that is going to help. At the same time, the second big change that's taken place in the last 3 decades is that I used to manage like $1 million for myself, in 1995, and now it's over $1 billion. So obviously that changes the universe of what you look at. So competence grows. If you're doing well, the assets will grow, and all of that will naturally drive some tweaks and changes to kind of what you're doing and where you're looking.
And when it comes to evaluating management teams, I believe you basically didn't really talk to managements as part of your process. Has that changed?
Yeah, I realized that I was doing my investor the disservice. I mean, the negative of interacting with management, which is what I taken from Ben Graham, is that they're great salespeople. That's what got the CEOs into their jobs to begin with. And so if you're talking to a great salesman about a subject he knows everything about and you know nothing, you're likely to get swayed. And I think that still happens to me. I still get swayed. But I think that many times the interactions with management can help you understand the nature of management and how they think about capital allocation and things, and how they think about their business and kind of the different decisions they're making and so on. So I think it can help long term to have a better sense of what they are all about and what these people are and how they think and so on. So if I have the choice, today I would spend more time with senior management and the CEO and such if it's available to me. And sometimes that's not a choice, and that's okay. We can kind of roll with that as well. Because none of this is related to anything that they can tell you which is going to help you next quarter or anything like that. I mean, we're looking 5, 10 years out. And like, for example, when I'm meeting the management teams and I, went into the mines of the different coal companies, the single greatest driver of how well we do long term with coal is the price of coal. And none of them can really help you with that. They just don't have any crystal ball that's better than your crystal ball. So that's the 800-pound gorilla in that case. But you can understand from the interactions, who would be the best companies and the best teams and, the best culture, and then, can kind of take it from there.
And it sounds like it's a combination, speaking of coal specifically, of good capital allocation, meaning buying back your own shares when they're undervalued. So it sounds like you can have a high degree of confidence that the management isn't going to misallocate capital there.
Well, I mean, I think that some of these coal plays, their reserves go out for 50 plus years. And it is quite plausible, and even I would say more than a 50% probability, that these mines may be running and these companies may be running till all the coal is gone. And they'll be running for 50 years or more. Because, the processes to make iron and steel, I mean, those are difficult to change. And some of those, the capex that goes in, to build blast furnaces, et cetera, there are brand new blast furnaces being built even right now to produce iron and steel in Asia and India, for example, that will last for 30, 40, 50 years. And so that capital is going in with the expectation that those plants are going to run for 3 or 4 decades. So, if you have a situation where a company has a market cap of, let's say, $2 billion, you think they're going to produce on average, let's say, $1 billion a year for 50 years, and then they disappear. Well, that would, to me, be the definition of an exceptionally great business. And I would say, where do I sign? And that's, I think, what things look like in 2023 when we looked at some of these coal plays, where we said, okay, we don't think the billion a year is going to come like clockwork. I think there might be years when it's 100 million or 50 million or zero, and there might be years when it's 2 or 3 billion. My bet was that if I fast forward 50 years and averaged it out, it might end up at $1 billion a year or more. And so if those are the numbers, those are fantastic bets to make.
Absolutely. And maybe more generally, how do you think about the length of that tail? Because some industries, they are in decline.
Well, what I'm saying is that if you're paying 2 billion, what do you care whether it's 10 years or 20 years or 50 years? Do you care? So one of the things about investing is a lot of comfort with uncertainty. So let's take a situation that a company has a market cap of 2 billion. And let's assume that it's going to produce on average a billion a year. So let's say it lasts for 5 years and disappears, or lasts for 10 years and disappears, or lasts 20 years or 50 years. In all of those answers, you make money. So there is uncertainty on number of things. The risk reward looks great.
Absolutely. I think that's a great way of putting it. Monish, wondering if you could talk a little bit about psychology, investor psychology, and what tendencies you have found that are most detrimental to investors, and if there's anything that you think is especially beneficial.
The most important skill for an investor to have is patience. I think that's the number one thing, is that all businesses, after you invest in them, are going to surprise you in many ways. Many times those surprises are negative. Sometimes those surprises are positive. But it's almost never going to happen that what you thought is how it's going to play out is how it actually plays out. So I would say the first skill set is extreme patience. The second skill set in many of these companies is a lot of comfort with uncertainty. So I've talked about this several times, that risk and uncertainty are two separate things. And a lot of investors get confused between the two. And a lot of investors are looking for certainty. And if you're looking for certainty, like Buffett says, you will pay a high price for a cheery consensus. So if you have comfort with uncertainty, and the greater the uncertainty with a low risk, a combination of high uncertainty with low risk is likely to give you great reward if you are patient. So I think that's the equation, and that would fit coal business. The risk is low, the uncertainty is high, patience is key, and one should love watching paint dry.
Great. Just coming back to the question about investable countries and how you think about that, are there any red flags where you would say, I don't want to touch anything in this particular country?
There's a number of countries where I just don't want to go. I don't want to go to Russia. I don't want to go to Venezuela. I don't want to go to Zimbabwe. I mean, there's a lot of countries like that where I think that basic, respect for property rights and basic respect for investor capital and, capital flows and such may be questioned. The good news is that an investor can have an extremely tight set of conditions that need to be met for them to be interested in going to a particular geography. I always talk about the example of John Arrillaga, who was Charlie Munger's friend, who only invested in real estate within a mile of the Stanford campus. That's all he did. And actually, if you walked with him around Stanford, every building he could tell you the history, the rents, kind of what has transpired, who owns it, whatever. He knew every single building cold. His knowledge was extreme. And John Arrillaga, died a billionaire, very narrow circle of competence. Obviously never invested outside the US, never invested out of California, never invested outside of that very tight radius around Stanford, and worked extremely well for him. So we don't need large circles of competence, and we don't need to be going to, esoteric places or countries. We should do what we're comfortable with. And I think that there's a lot of opportunity everywhere. So it's a question of, how well you are versed in seeing it and acting on it.
If you were starting from scratch today, let's say with $1 million, how would you do it?
Well, I think that the anomalies would be of deep interest. So these are, these weird special situations and such, because we could go into a lot of nooks and crannies that we can't go into with the funds. I could even do some of it with long-term options and such. So I think that the focus would almost completely be on these special situation anomalies and kind of take it from there, because we'd be putting like $100,000 to work on a given idea. And if you're going to put 100,000 to work, there's a huge universe of opportunities to look at, because almost anything is a possibility. So that's what I would do.
So basically take advantage of the small size to do things that bigger funds cannot do.
Yeah, one of the interesting things about investing is, and I think Joel Greenblatt had pointed this out, he said that if you are a really good investor and you're starting out and you have a very small amount of capital and you do very well. So let's say you start with $100,000 or $1 million. Well, if you're exceptional at what you do, what will happen is that that million is going to grow to 10 million or 100 million or a billion. The very tiny stuff that you were doing when you started, in a few years or maybe a decade, you won't be able to do it anymore because it just would make no sense for you. So you would have to leave those, what I would call fertile pastures, to find larger, not so fertile pastures, which still have some good yield. But what ends up happening is that you open up that white space for a new young person coming in with 100,000 or $1 million. So basically, in effect, what's happening is the very low end of the market has this constant exodus taking place of the best players. So the ones who are extremely good at it have no choice but to leave that space. So it's kind of an evergreen situation where that kind of batch graduates, and then those opportunity sets are available for the next batch, and then that next batch graduates and it's available for the next batch after that. So it's kind of evergreen from that perspective, in the sense that if you are looking in these nooks and crannies, there is a lot of opportunity because the guys who are really good at it have already moved on. They had no choice but to move.
That's a great dynamic, and I think provides opportunity for new investors coming up.
Absolutely. I mean, it just makes the business very exciting. And this is also an interesting business where the little guy has a big advantage over the big guy. The little guy has a huge advantage.
Yeah, and I think sometimes there's a misconception around that. A lot of folks think, well, the big firms, they can move markets and they got all these resources, but actually there's a lot of opportunities they can't even look at because they're so big.
I have a friend of mine who runs a small fund, and he's extremely good at options. I mean, he studies his businesses really well, and then he finds the ones which kind of lend themselves to these different option bets. And, he's consistently been over 50% a year. But his total capital under management is small. I mean, it's grown a lot, but it's still relatively small. And he was doing this on student loan float, like Lilu, a while back. And now he's past that and he has a small fund. But the thing is that he will have to leave those pastures, in the sense that, the capital will just get too large. And it won't even be that long. It might be a year or two. And he's got to go, you know, play somewhat differently. But he's enjoying it now. And so then those pastures will get left to the next guy.
Well, it's always good when you leave something for the right reason, for a positive reason. And Monish, we maybe we'll end on this. We always like to ask about books that we should be reading, learning from. Is there anything that you would highlight that maybe you haven't talked about before a lot that could be of value to our members?
Sure. Whenever I used to go to Charlie's place for dinner, probably I would have dinner with him, 4 or 5 times a year. There would always be all these books around, there's a few tables around where he would sit, like a lot of piles of books. And a lot of these were books that people had sent to him. So I'd always like kind of take pictures of the different books, and I'd ask him about which ones he's read and what he thought about them, etc., and so on. So in one of my last visits with him, I saw this book called The Joys of Costco. And someone had sent it to Charlie, and I asked him if he had read the book. He said, yeah, he. And he said that it's not exactly Shakespeare, it's not the highest quality literature, but it's a very good effort. And so I bought the book, and I really enjoyed it. It was basically a couple that are diehard Costco fans, and they visited, I think, hundreds of Costco stores. I mean, it's kind of their thing to do, is they just keep going from one Costco to another. And they kind of put it together in a book with all these kind of quirky factoids about Costco. And I think they did a very good job. And it's a colorful book and it's easy to read. And I sent that book out to people on my Christmas list this year. And I got more comments than normal when I sent books out. It actually hit a nerve with a lot of people. I think because a lot of people are such dear fans of Costco and actually taught you a few things about how to even improve your Costco experience or get more out of it, etc. So I thought that was a great, and it actually shows one of the things that book did really well. It just showed the incredible moat of Costco. Every time I'd meet Charlie, at least 30 minutes was on Costco. Somehow or the other, the conversation would always go to Costco. And he'd always want to spend time on some nuance of it. So I think that might be a book people might enjoy.
Well, I can tell you I'd love to have a Costco in Switzerland. I'd probably travel the whole country. It's a small country, but still, it would be a
It'll come.
highlight.
Don't worry. It'll come. It's just that they've got such a long list of places and stores to open, so they're cranking along.
Well, the one good thing about having missed the stock and it being so expensive is that I'm kind of sure it'll come because there's so much growth priced into the stock that it has to come.
Absolutely. I think the runway for Costco is very long.
Well, Mohnish, we will leave it on that note. Very grateful to you, as always, for taking the time and really entertaining all the questions. It's great education for our members and the broader investment community. You've been such a great member and mentor to all of us. Thanks once again, and we'll be looking forward to reconvening in a couple of years, if not sooner.
John, I just want to say that you do a tremendous service to the value investing community. And I think the Manual of Ideas is just a terrific offering to the community. So very grateful for your effort. So thank you.